Welcome to the deep dive. Today we're tackling something really fundamental to understanding how a company's really doing.
Financial statements.
Exactly.
Yeah.
Company financial statements. It's surprising how many investors, even, everyday folks, tend to skip over these.
Yeah, they seem complex, maybe a bit intimidating. Lots of numbers.
Right. People look at products, maybe get a feel for the company, but they don't always lift the financial hood. It's kind of like buying a house just because it looks nice from the street.
That's a great analogy, but honestly, getting the basics isn't as hard as it looks.
And it's so insightful. It can show you potential opportunities or maybe some hidden risks.
Absolutely. You move from just knowing what they do to understanding how well they're actually doing it.
So that's our mission for this deep dive. We want to, well, pull back the curtain a bit.
Yeah, look at the main building blocks, explain what the key parts mean.
Show you it's not some secret code only for finance pros.
Oh.
Think of this as your guide to decoding a company's financial story.
And we need an example to make it concrete, so we'll use Tesla.
Good choice. We're looking at their quarterly results, right? From the start of 2020.
That's right, first quarter of 2020 from their official SEC filing the 10Q report.
Okay. And we should mention, these statements can look slightly different sometimes.
Oh, for sure. Depends on the company, the industry, maybe even the country.
But for big U.S. companies like Tesla, the ones listed publicly, they have to file these reports.
Yep. Mandated by the SEC. You've got the annual one, the 10K that's audited, more detail.
And the quarterly one, the 10Q, which is what we're using today, less detail but more frequent.
And inside these filings, you'll always find the big three.
The three main financial statements.
Exactly. The balance sheet, the income statement, and the cash flow statement. Together, they give you the full picture.
Okay, let's start with the first one, the balance sheet.
Right. Think of this one like a photograph.
A snapshot.
Exactly. A snapshot in time. It shows you what a company owns.
Its assets.
Its assets. And what it owes to others.
Liabilities.
Liabilities, yeah. And the difference between those two, that's what belongs to the owners, the shareholders.
That's their equity.
That's equity. And it all has to tie together with that fundamental accounting equation.
Ah, you mean assets, liabilities, plus equity?
That's the one. It
Yeah.
must balance. Always. It's the core logic.
Okay, so this snapshot, this balance sheet, is broken down, right? What are the main sections?
Typically 5 main parts. You've got current assets and non-current assets.
Okay.
Then current liabilities and non-current liabilities.
Right. Assets and liabilities split by time.
Exactly. And the 5th piece is that equity we just talked about.
Got it. So let's start with assets. Current assets first. What falls in there?
Current assets are things the company expects to, use up or turn into cash pretty soon, usually within a year.
To keep things running day to day?
Precisely. They're listed by liquidity, how quickly they can become cash. So for Tesla, back in Q1 2020, this was things like, actual cash.
Makes sense.
Cash equivalent stuff that's almost cash, like very short-term investments.
Oh.
Then accounts receivable.
Money customers owe them?
Yep, for cars already delivered, for instance. Then inventory, their cars, parts, and prepaid expenses.
Things they've paid for but haven't used yet, like insurance.
Exactly. Insurance, maybe rent paid in advance, stuff like that.
Okay, so that's the short-term stuff. What about the other side? Non-current assets. Long-term things.
Exactly. Non-current or long-term assets are things they'll hold on to for more than a year.
Like factories.
Definitely. Property, plant, and equipment. PP&E. That's a big one for manufacturers like Tesla. Their factories, machinery.
Okay.
But for Tesla, you also see some specific things like vehicles they own but lease out to customers, or their solar energy systems that are under lease.
Right, linked to their business model.
Yeah. And then you have intangible assets. Think patents, trademarks.
Things you can't touch but still have value.
You got it. And maybe goodwill if they've bought another company for more than its assets were worth on paper. These are the things that support long-term earning power.
Okay, that covers the owns part. Now the owes part, liabilities. Same split. Current and non-current.
Same idea, yes. Current liabilities are debts or obligations due within the next year.
Like paying suppliers.
Exactly. Accounts payable, money owed to suppliers. And an interesting one is deferred revenue.
Deferred revenue. What's that again?
It's cash they've received from customers, but for products or services they haven't delivered yet.
Ah, like deposits for a car they haven't built.
Could be, yeah. So even though it's cash received, it's a liability because they still owe the customer something.
Okay, that's important. What else is current?
You'd also see the portion of their long-term debt that's due within the next 12 months, the current portion.
Gotcha. So that naturally leads to non-current liabilities, the longer-term debts.
Precisely. Obligations not due within the next year. This is typically where you find the bulk of their long-term debt bonds they've issued, bank loans stretching out for years.
Okay. Maybe longer-term deferred revenue, too.
Potentially, yeah. These represent the company's, more distant financial commitments.
All right. Assets covered, liabilities covered. That leaves the final piece of the balance sheet. Equity. Remind us what that represents.
Equity or shareholders' equity is essentially what's left over for the owners after you subtract all the liabilities from all the assets.
Kind of the company's net worth from the shareholder's view.
That's a good way to put it. If the company theoretically sold everything and paid off all its debts, equity is what the shareholders would get. A positive number suggests they can cover their debts.
And what makes up that equity section usually? For Tesla, for example.
You'll see things like the value of the shares they've issued, maybe additional money shareholders paid above the basic share price, called additional paid-in capital.
Okay.
And a really important one, retained earnings.
Retained earnings. That sounds like profits they've kept.
Exactly. It's the sum of all the profits the company has made over its entire history, minus any dividends it's paid out. It's the profit reinvested back into the business.
So growing retained earnings is generally a good sign. Shows profitability and reinvestment.
Generally, yes. It signals they're building value within the company, hopefully funding future growth.
Okay, great. So the balance sheet gives us that static picture. Now let's switch gears to the income statement. This one feels more like a movie than a photo.
Yeah, that's a good way to think about it. The income statement, sometimes called the P&L, profit and loss, or statement of operations, shows performance over a period.
Not just one point in time, but over a whole quarter or a year.
Exactly. It tells you if the company made money or lost money during that specific time frame. Revenue coming in, expenses going out.
And how do companies like Tesla usually structure this? Is it just revenue minus expenses equals profit?
It's a bit more detailed usually. Public companies often use a multi-step income statement.
Multi-step. Meaning
They break it down to show profit at different stages. They separate out the results from their main business, their operating activities from other income or expenses like interest.
okay, so for Tesla, selling cars is the main operation.
Right. So the statement helps you see how profitable that core activity is.
So walk us through those steps. Where does it start?
It starts the top line, total revenue. All the money brought in from sales cars, energy products, services, etc. during that period.
Okay, the total sales figure, then what?
Then you subtract the cost of revenue or cost of goods sold, TOG. These are the direct cost of producing what they sold.
For Tesla, that'd be materials, factory labor for the cars they sold.
Exactly. Raw materials, components, the direct labor involved in manufacturing. Subtracting COGS from revenue gives you the first level of profit, gross profit.
Gross profit. So how much do they make just on selling the product itself before other business costs?
Precisely. It shows the basic profitability of their products.
What comes after gross profit? We need to account for running the business, right?
Right. Next, you subtract operating expenses. These are the costs of being in business that aren't directly tied to making the product.
Like what? Salaries, rent.
Yep. A big one for Tesla is R&D, research and development, investing in new tech, new models.
Crucial for a tech company.
Absolutely. Then you have SG&A, selling, general, and administrative expenses. This covers sales commissions, marketing, executive salaries, office rent, admin staff, all that overhead.
Okay, so gross profit minus all those operating expenses gives us
Operating income, or operating loss if expenses are higher. This is a key number. It tells you how profitable Tesla's core business operations were.
Right. Profit from actually making and selling stuff separate from other financial things. What are those other things?
Well, after operating income, you account for non-operating items, usually things like interest expense, the cost of their debt,
Okay.
or maybe interest income if they earned interest on cash they hold. Adding or subtracting these gives you income before tax.
Almost there. Just taxes left.
Just taxes. Subtract the estimated income tax expense, and you arrive at the bottom line.
Net income or net loss.
That's it. The final profit or loss for the period after everything has been accounted for. That's the number that gets a lot of headlines.
Okay, so income statement shows profit. Balance sheet shows assets and liabilities. But profit isn't always cash, is it? I mean, you can report a profit but still run out of money.
That is absolutely critical to understand. Yes, Profit on the income statement includes non-cash items sometimes, and it doesn't track the actual timing of cash receipts and payments.
Which is why we need the third statement, the cash flow statement.
Precisely. Cash is king, as they say. Or maybe cash is oxygen for a business. You need it to survive day to day.
It's about liquidity, right? Having enough cash to pay bills.
Liquidity, yes, short-term obligations. And solvency, long-term financial health. You can be profitable on paper, but if you don't manage your cash flow, you can become insolvent. Run out of cash, can't pay debts, can't pay employees.
And that leads to business failure, even for profitable companies sometimes.
It's a major reason businesses fail. So the cash flow statement tracks the actual movement of cash and cash equivalents, money coming in, money going out.
It shows how much cash is really available.
Yes. And it breaks down where that cash came from and where it went. It's usually split into three main activities.
3 sections. What are they?
Cash flow from operations, cash flow from investing, and cash flow from financing.
Okay, let's take them one by one. Operations first.
Cash flow from operating activities, or CFO. This tracks the cash generated or used by the company's main business activities.
So for Tesla, selling cars and energy stuff.
Exactly. It starts with net income, usually, then adjusts for non-cash items that were on the income statement, and for changes in working capital, things like inventory, accounts receivable, accounts payable.
So it connects the income statement back to actual cash.
It does. It shows how much real cash the core business is generating or consuming. Ideally, you want to see consistently positive cash flow from operations. That's a healthy sign.
Okay, operations is the core business cash. What about investing activities?
Cash flow from investing activities, CFI, relates to buying and selling long-term assets.
Like the factors and equipment we talked about earlier, PP&E.
Exactly. When Tesla spends cash to build a new factory or buy machinery, that's a cash outflow in this section, an investment.
Makes sense. They're investing in the future.
Right. If they were to sell off an old factory or some equipment, that would be a cash inflow here.
Does this section tell you if those investments are good investments?
Not directly, no. It just shows the cash spent or received. You'd need more context, more analysis to judge the quality or potential return of those investments.
Okay, so operations cash, investing cash. What's the third one? Financing.
Cash flow from financing activities, CFF. This section tracks cash flow between the company and its owners and lenders.
So how the company gets funded.
Pretty much. If Tesla issues new shares of stock to raise money, that's a cash inflow here. If they take out a new loan, that's also cash in.
And cash going out.
Cash outflows would be things like repaying debt or buying back their own stock. Or paying dividends, if they did that, which Tesla historically hasn't.
So it shows how they're managing their capital structure, debt, and equity.
Exactly. It completes the picture of all the major ways cash moves through the business.
Okay, wow. So wrapping it up then, we've got the balance sheet.
The snapshot.
Ah.
Assets, liabilities, equity at a point in time.
The income statement.
Performance over a period. Revenue, expenses, profit or loss.
And the cash flow statement.
Tracking the actual cash. Operations, investing, financing.
And just understanding those three, even at this level, gives you a much better grip on what a company is doing financially, doesn't it?
Absolutely. Even just knowing what's in each main section and what it generally represents allows you to read these statements and get real insights. You're way ahead of the game.
So for anyone listening who wants to, take the next step, what would you suggest?
Well, I'd really encourage you to actually go and find some financial statements. Go to the SEC's EDJR database online. It's all public.
Download a 10K or a 10Q for a company you're interested in.
Exactly. Maybe pick a couple from different industries. See how they compare. Try to spot the sections we talked about. Current assets, operating income, cash from operations.
Just practice reading them.
Yeah, see if you can start to piece together the story the numbers are telling. It gets easier with practice, like anything. It's like learning to read a map. The more you do it, the more the landscape makes sense.
That's great advice. Okay, here's a final thought to leave you with. We've talked about how these statements look backward. They report on what has happened.
Right, they are historical documents.
So think about this. How does understanding this past financial performance change how you think about a company's future? Especially when you combine it with what you already know about their products, their market, their strategy.
Yeah. How does the financial reality mesh with the business story?
Exactly. What new questions pop up when you look at both the numbers and the narrative together? Something to ponder.